Tesla has reported its steepest drop in quarterly revenue in over a decade. In the second quarter, sales dropped 13.5% compared to the same period last year. The electric car maker has been facing headwinds with mounting competition, a lack of new car models, and consumer backlash against its CEO Elon Musk hitting sales. The company is expected to put a new affordable EV model into large-scale production later this year.
Tesla just missed its Q2 earnings, but instead of slowing down, they dropped a surprise: a cheaper EV is coming in 2025. Is this the comeback move no one saw coming? Tesla just reported its Q2 earnings for 2025, and things aren't looking as strong as investors had hoped. The company brought in $22.5 billion in revenue, which fell slightly short of the $22.64 billion analysts were expecting. But the bigger concern is the year-over-year drop. That's a 12% decrease from the same quarter last year. Net income also took a hit, falling 16% to about $1.17 billion. This marks the third straight quarter of declining profits, which is not something Tesla fans are used to seeing. A major reason behind this drop is a slowdown in vehicle deliveries. Tesla delivered around 384,000 cars in Q2, down 14% compared to last year. And if that wasn't enough, Tesla's income from selling regulatory credits, something that used to be a big help to their bottom line, was also cut in half, falling from $890 million to just $439 million. All of this paints a clear picture. Demand is cooling, and Tesla's usual ways of staying profitable aren't holding up like before. Elon Musk didn't try to sugarcoat the situation. He called the second quarter a weird transition and warned that things might stay uncertain for the next few quarters. There are a few reasons why. First, some federal EV tax credits are going away, which could make Tesla's cars more expensive for buyers. Second, there's growing pressure from regulators, especially around Tesla's self-driving tech. And third, the global economy is still shaky, which always makes big purchases like electric cars a tougher sell. The stock market responded quickly. Right after the earnings call, Tesla's stock dropped more than 4.5% in after-hours trading. But despite the weak numbers, Tesla isn't in financial trouble. The company still has a huge cash reserve of $36.8 billion, which gives it a strong safety net while it adjusts to this new phase. That's a big advantage compared to many competitors in the EV market who don't have the same financial cushion. Tesla hasn't just talked about a new affordable model, they've already started building it. According to Tesla's CFO, early production has begun, and full-scale output is expected by the second half of 2025. This isn't just a plan, it's already in motion. For investors and fans who were concerned about Tesla's weak Q2 results, this news acts as a sign of confidence. Tesla knows the numbers weren't good, and they're already making moves to address the slowdown in sales and revenue. This next step could be the one that pulls them out of the slump. Tesla hasn't yet revealed the name or price of this more affordable EV, but inside sources suggest it will be a simplified version of the current Model Y. By keeping the design and production line mostly the same, Tesla can cut development time and costs. It's not the all-new Model 2 that was once hyped as a $25,000 game-changer, but it's a smart step forward. The company appears to have shifted its focus toward practicality. Rather than building something from scratch, it's making a strategic use of its existing platforms and factories. This lets them move faster and reduce financial risks. This decision aligns with how Elon Musk described the current moment as a weird transition for Tesla. It's a time when the company is juggling several big changes. EV demand is cooling, competition is rising, and major bets on autonomy and robotics are still developing. But Musk remained confident in the company's long-term vision. He emphasized that Tesla is not standing still, even during rough quarters like this one. Instead, they're working on refining their strategy, relying more on automation, improving factory efficiency, and bringing more affordable vehicles to market. The company also recently launched limited testing for its robotaxi service in Austin, Texas. Although the test is small, it signals that Tesla is doubling down on autonomy. Even if traditional EV sales stay slow for a while, self-driving vehicles could unlock a new revenue stream. That's a key part of Tesla's long-term plan, to not just be a car company, but a full technology and transportation provider. So, the timing of both moves, the robotaxi trial and the affordable EV project, suggests Tesla is preparing for the next wave of mobility. But this shift comes at a cost. In Q2, Tesla's auto sales dropped by over 13%, and its revenue from regulatory credits, another important income stream, was cut in half. Tesla earned only $439 million in credits, down from $890 million a year ago. These credits used to give Tesla an edge, especially when competitors struggled to meet emissions targets. But now, with more automakers going electric and global policies changing, that source of income is drying up. It's one more reason why Tesla needs to bring in new buyers with more accessible pricing. At the same time, Tesla's free cash flow fell sharply, dropping nearly 89% to just $146 million. The company blamed this drop on higher spending for new factories, R&D, and future projects. That may be true, but it also shows that Tesla's financial cushion is thinning. If demand stays weak, and if the affordable model or robotaxi rollout face delays, Tesla could be under even more pressure by early 2026. It's a risky balancing act. Innovate aggressively, while keeping costs under control. Gross margins, excluding those regulatory credits, came in at just under 15%. While not disastrous, it's lower than Tesla's historic margins, which used to be among the highest in the auto industry. Investors used to love Tesla for its profitability, but now they're watching those margins slip as Tesla cuts prices and faces more competition. It's a sign of the new EV landscape: price wars, aggressive marketing, and tighter margins. Tesla is no longer the only one with compelling EVs. Companies like BYD, Hyundai, and even Volkswagen are catching up. Elon Musk's strategy, it seems, is to adapt rather than retreat. Tesla is pushing ahead with plans to scale production, automate its factories, and introduce new tech like its unboxed process, which aims to make manufacturing faster and cheaper. It's also working on the next-generation vehicle platform, a flexible system designed to produce both standard EVs and autonomous versions. The idea is that once production ramps up, Tesla will be able to build different models at different price points using a streamlined, low-cost setup. The question is, will buyers wait? The promised affordable model won't arrive in large numbers until late 2025. And while Tesla fans may be patient, everyday consumers looking for a new car now might not be. If they can't afford a Tesla today, and there's no firm date or price on the cheaper one, they might turn to competitors. That's especially true in places like Europe and China, where brands like BYD are already selling EVs for under $20,000. In fact, in markets like these, Tesla's biggest threat may no longer be legacy automakers, but fast-moving Chinese firms. And then there's the political angle. Some consumers have cooled on Tesla because of Elon Musk's public statements or controversial posts on social media. For a brand once seen as futuristic and progressive, that change in public perception could be damaging. In recent surveys, some buyers admitted that they're skipping Tesla not because of the cars, but because of the man behind them. That adds another layer of pressure. The affordable model will need not just the right price, but also the right message. It has to attract first-time EV buyers without alienating those turned off by the brand's image. Internally, Tesla is also dealing with past confusion about this affordable model. Earlier this year, reports leaked that the long-hyped $25,000 vehicle had been canceled. Tesla quickly denied it, but insiders later confirmed that a version of the project was scrapped, only to be revived in a different form. That could explain why the new affordable model doesn't have a name or a set design yet. It's likely a more conservative project now, less revolutionary, but more realistic. And that's probably a smart move in a year like this. Tesla's strategy seems to be, take fewer risks on new platforms and focus on execution. That's why this new car is likely based on the Model Y's chassis and tech. It saves time, avoids costly retooling, and lets Tesla bring something to market quickly. It's not the most exciting path, but given the market conditions, it may be the right one. This approach also gives Tesla a chance to test demand and refine pricing before launching an entirely new model or platform in 2026 or later. Still, there's a lot riding on this. If Tesla nails the pricing, somewhere in the low $30,000 range, it could open the door to millions of new buyers. Tesla would then have a full product lineup, high-end models for premium buyers, and a new affordable EV for the masses. And if it can produce that car efficiently using the unbox method, it could even maintain decent margins. That's the ideal outcome, a comeback in sales, improved cash flow, and momentum heading into 2026. But if things don't go as planned, if production is delayed, or if the price disappoints, then Tesla could lose valuable ground. The EV market is no longer waiting. Legacy brands are investing heavily, and startups are innovating faster. For Tesla, the next 12 months are critical. The company must show that it can still lead, not just follow. It must prove that affordability, efficiency, and innovation can go hand in hand. For now, all eyes are on Tesla's factories and its timeline. Will the new model arrive on schedule? Will it be priced competitively? Will buyers come back? These are the questions that will define Tesla's next chapter. Because in the end, it's not just about one car, it's about Tesla's future. The road ahead may be uncertain, but one thing is clear: Tesla isn't done yet. It's still trying to lead the EV revolution, even in the face of its biggest challenges. Tesla's next move could change the EV game in 2025. Want to stay ahead of it? Hit subscribe and don't miss what's coming next.